Hi everyone! 2026 is off to an explosive start for the nickel and the stainless steel market. As of January 8, we saw that the Shanghai nickel contract closing at $20,877 per ton, surged at least 33% from the last year bottom. Meanwhile, the stainless steel contract report at $2,000 per ton. What is interesting here is the drop in open interest for both, suggesting that the short sellers are likely covering their positions as the price breaks upwards. LME nickel surpassed $18,000 and marks a new high since September of 2024. In the spot market, the reaction was immediate. Distributors hiked their prices to keep pace with the future market. However, because supply remains incredibly tight, many sellers are holding onto their stock, creating a reluctant to sell environment that is pushing supply level even lower. So, what is driving this rally? The main trigger comes from Indonesia. The Indonesian Nickel Miners Association recently revealed that the government plans to slash nickel mining quotas for 2026. They are targeting approximately 250 million tons. To put that in perspective, the quota in 2025 was 379 million tons. That is one-third reduction. Indonesia's goal is clear: control the supply to support prices and ensure that the raw materials output aligns with downstream smelting capacity. If this quota is strictly enforced, we are looking at a massive supply gap of about 77 million tons. That news alone was enough to send nickel prices into orbit in the short term. Beyond policy, the global landscape is getting more complicated. From the Americas to Central Asia and even up to the Antarctic Circle, geopolitical tensions have intensified in early 2026. For traders, the logic is simple. Uncertainty drives demand for hard assets. As long as this conflict persists, we are expected to see precious metals and non-ferrous metals continue the upward trend. Now, let's look at the fundamental of stainless steel. In December of 2025, domestic production dropped by about 6.5% month-on-month, while January of 2026 production is expected to tick up slightly, about 1.8%. The overall supply pressure has actually eased. We're seeing a significant downward trend. Total social inventory is currently around 977,000 tons, a nearly 3% drop week on week. We are also witnessing a classic commodity market rotation. We have seen the rally move from gold to silver, to copper, and now it's hitting non-ferrous metals. As this cycle continues, we have expected the ferrous metal sector, including stainless steel, to be the next big mover. Finally, a quick update on export license, a topic we have been covering closely on our LinkedIn newsletters. Currently, these new licensing requirements have extended the shipping times by about 1 week. We expect this review period to shorten as the process becomes more streamlined. Who is feeling the heat? Mostly non-compliant exporters and those with goods that are already in transit but hadn't cleared the border before January 1st. These in-between shipments are forcing buyers and sellers back to the negotiating table, and in many cases, suppliers are having to absorb the cost of no compliance. In the end, this move is designed to standardize the market. It's going to end the practice of tax-free quoting and allow for much tighter monitoring of export data, which is a win for the market's transparency in the long run. The bottom line: between Indonesia's supply cuts and global geopolitical shift, the market is a very volatile phase. If you want a deeper dive into the export license policy or need our latest prices sheets, feel free to reach out to us directly or subscribe to our newsletter on LinkedIn. Thanks for watching and see you in the next update. Bye!